Today we're talking about the 10 principles of wealth building. If you want to see your money actually work for you, you need to understand these. But I'm not going to give you the same old save and budget advice because that doesn't build wealth. Instead, I'll walk you through the master plan, what actually grows money from scratch, who usually profits when you invest, and how to flip it so that you can be your own financial advisor, the tax hacks that let you keep more, and the steps that help you design the life that you want. I've spent the last decade building my own wealth from scratch through books and degrees and lots of trial and error. No one teaches this, and that's why I want to give you the version of the master plan I wish that I had when I first started. Let's get into it. Starting with principle number 1, your wealth is built outside of your job. I've read dozens of the most respected books on money and wealth building, from The Millionaire Next Door to Intelligent Investor and The Rich Dad Poor Dad. Across all the case studies, the same fundamentals repeat. Live below your means, save intentionally, and plan for the long term. But here's the truth, those books also make very clear. A paycheck by itself won't build meaningful wealth. Wealth comes from what you do outside of the job. I want to break this down using the 2 basic formulas. The first formula, that's our day-to-day living, what we all operate on, is income minus living costs equals investable money. The second formula is how we build wealth. Wealth equals investable money times rate of return times time. For the rate of return, we'll assume an average stock market return rate of 8%. This part we don't really have control over. The other 2 components, investable money and time, become our levers that we can control and influence the outcome. Lever 1 is time. This lever is very slow, so unless you already have a lot of capital or plenty of time, your ways to leverage it for yourself are limited to the number of years between now and when you retire. You have much better chance of doing it for your kids and grandkids if you miss the boat for yourself. If we're looking at a 10-year horizon, investing $500 a month at 8% will yield $87,000. The second lever is your investable money. So if you're able to increase your monthly amount to $2,000 over the next 10 years, you'll be at $348,000. For comparison, to reach that same amount at $500 a month, you'll need to double the investment timeline. So that's a pretty significant jump and significant difference. So if you're looking at the second lever, your investable money, here are 2 ways you can increase it. One is by continuously working towards increasing your salary or working more hours. And another path is to start a business. It's harder upfront and more time consuming, but it can increase your income and potentially builds a path to have passive income in the future. Now that you know that although there are 2 levers to the wealth formula, the one that you can truly control is your investable money. So focus on increasing that and automating what you do with it. Principle number 2 is the formula of effort times consistency times system. Imagine trying to learn piano just by relying on willpower. Every day you ask yourself, do I feel like practicing today? Do I run scales? Do I work on that song? Some days you do, some days you don't, and the progress is slow and inconsistent. Now think about the exceptional piano players, elite athletes, or Navy SEALs. They all follow structured routines. Athletes schedule workouts and recovery. Pianists have fixed practice blocks and technique drills. And Navy SEALs follow strict mission checklists, and progress happens automatically because these actions are built into a system. The formula for progress then becomes effort times consistency times system. The same principle applies to building wealth. Now that we're on the same page that building wealth is, in simple terms, actively pursuing ways to make more money, whether by accumulating skills to get a raise or building a side business, this effort can't rely on willpower alone. So you can apply the same formula to your own life. Effort is the work you're putting in. Consistency is built around goal planning and setting aside time blocks to work towards your goal. And system is translating your effort into repeatable steps, creating checklists, templates, tracking, and feedback loops. This way, progress will continue happening even when motivation dips or life gets busy. And having the structure will help you get back on track after every setback. Principle number 3. Fees are silent wealth killers. Here in this table are the 3 most common types of funds available to regular investors like you and I. The key thing to understand here are, number 1, performance across all of them is about the same. Balance funds combine asset classes to protect your money. So you might see a combination of stocks and bonds, which will decrease your risk level at the cost of decreased performance. Now let's look at the fees and notice who actually gets paid and why. Index funds keep the costs low and profits go mostly to investors. Balanced funds give you auto rebalancing to stay with that specific mix that you selected. So you're paying a little extra for that compared to indexes. Actively managed funds pay managers, research teams, and sometimes require you to have an advisor to try to beat the market. But the result is, after the fees, these funds often underperform compared to indexes. So bottom line is, you're going to get average results whether or not you pay higher fees. But if you want a slightly more hands-off approach, going with a target or balanced fund is a good idea so you don't have to manage your asset mix. And here's another key thing. The finance industry profits by keeping you feeling overwhelmed and confused so that you continue paying for advice that you don't really need. When you decide to go with a financial advisor, usually at a cost of 1% fee, you're paying that fee on top of all the fund fees that are already part of your portfolio. And when letting your financial advisor manage your portfolio, you give up control of what those fees might be because now it's your financial advisor who is picking the funds for you. I 100% believe that with some education and practice and one-off consultations with professionals, you can manage your own portfolio. So if you're interested in DIYing the services that a financial advisor provides, I made this tool for you with clear steps on how to be your own financial advisor. It's free. I'll post the link to download this in the description of the video. So for reference, here's what a 1% fee costs over 30 years if you're investing $500 a month. That's about $130 grand. And here's the impact if you're investing $2,000 a month, almost $500,000. If you nail the principles from today's video, you can easily DIY this and avoid losing out on that money. Principle number 4, cash flow is the real measure of freedom. Net worth has been a really popular concept lately and a very important one. It shows us where we are in terms of our assets. However, even a high net worth can't beat a strong positive cash flow, meaning that you have more money coming in than out. And if the amount of money coming in is not tied to your income, that's the real measure of freedom. You may have millions in net worth, but if it's all tied up in illiquid assets like your home, retirement funds, and you still have to show up to work every day to keep up funding your lifestyle with active income, that high net worth is of no benefit to you. If you have higher cash flow and more money coming in without having to clock in every day, that's real financial flex. You can cover your expenses, invest, and take risks without being chained to your job. Principle number 5 is the 50-30-20 rule. When it comes to money, I always recommend a simple approach. Pay your bills first, then pay yourself, and then see how much is left for spending. A helpful starting point is the 50-30-20 rule. 50% for essentials, 30% for lifestyle, and 20% for savings and investments. I like to go with that and then trim the 30% down a little so it feels tight but still manageable, and put the extra into your savings. Never shortchange your investments and always look to cut bills or increase income first. Your personal plan should evolve as you do. What works at 28 won't be right at 48. So review, adjust, and make sure that your money reflects your current goals, not your past ones. Principle number 6 is to widen the gap. That's the gap between your income and expenses. I've read dozens of personal finance books, and not a single one shares a story of someone who became a millionaire just by cutting expenses. Living below your means matters, but it alone won't get you there. People who actually build wealth focus on growing their income and investing the difference, not clipping coupons or skipping lattes. So here's a simple illustration. If you invest $500 a month at 8%, that's your baseline. Cutting $50 in monthly expenses adds only about $9,000 to your bottom line over 10 years. It's very small, but getting a 20% raise and increasing your investment by 20% every 2 years can grow your money by 146% over the same time period. A 20% raise every 2 years isn't unrealistic. It's actually a modest, achievable outcome if you focus on skill growth and strategic career moves. Most people assume that it's harder than it is, and that assumption in itself limits what they go after. So treating it as your expected trajectory changes how you approach your career. Instead of assuming that it's a really hard path, assume that it's your only path. and it will change how you negotiate and how you invest in yourself. And that mindset alone puts you on a very different wealth path. The other part of the gap that you have control over is expenses creep, and it usually falls into two categories. It's your lifestyle inflation and your small everyday purchases. Lifestyle inflation is the real wealth killer. So it's really important that your living costs are aligned with your goals, not your pay increases or desire to be keeping up with the Joneses. If your bigger spending stays aligned with your goals and you are continuously increasing the gap between income and expenses, small purchases like lattes won't matter in the long run. Principle number 7, design your life beyond your paycheck. Most traditional advice tells you to save more, work longer and harder, or chase bigger titles. But no one tells you to take 30 minutes and to think about what kind of life you actually want. What you want your days to look like, what time you want to wake up, what people you want around you. So following the traditional advice without thinking is like packing for a trip without knowing where you're going. You bring stuff you don't need and leave behind what matters. So before you invest your time and money on the traditional definition of success, ask yourself these 3 questions. What does my ideal life look like? And be very specific how much free time you want, which experiences and what priorities matter most. Which actions with my money and time actually move me toward that life? If you have spare money and time, would you want to invest it into a career skill so that you can keep on climbing a corporate ladder? Or would you rather start a business and spend your time and energy there? Everyone will have a different answer, and it's important that you have your answer and pursue the thing that is right for you. And the third question is, how will I protect my energy? Treat your energy like money. If you wouldn't spend your money on small, unimportant things, don't spend your energy like that either. Decide what you will say no to and what changes you're going to have to make to your daily routine. How you will plan your work so that it's not taking up all of your free time. Principle number 8, luck happens to the prepared. We're talking about cash and liquid assets. So in the formula where luck equals preparation times opportunity, cash is the preparation. When you're prepared, opportunities don't feel random anymore. You can actually pursue them. The things I'm talking about is buying assets at a discount during a stock market dip, or investing in your or someone else's business with a potentially high return, or an ability to hold out strong in salary negotiation for a position and salary you set an eye on instead of accepting the first offer out of being desperate. That's the preparation part of the formula. When it comes to wealth building, having cash on hand or liquid assets that you can turn quickly into cash is what gives you leverage. The important thing to understand here is that an asset is something that builds value over time, something that you can sell for more than what you bought it for. Think your investment portfolio or your property or education. A liability is something that depreciates, like clothes or designer bags or cars or watches. They all lose value once you take them home. Both of these might be liquid to a certain degree, but the key is to invest in something that you can sell later down the road for more than what you paid for it. Principle number 9 is complexity is the enemy of execution. When I first started figuring out how to manage my money, I went through so many options. I had a special debit card for spending money. I had multiple savings accounts for different goals, only for most of them to remain at near zero. My investment portfolio was quite complicated, only for me to realize one day that many of the companies that were included in the different funds I was holding were the same. So my portfolio was about as vulnerable as a handful of single stocks. So I intentionally found ways to simplify the system. All you need is one credit card for everyday spending, one checking account to pay the bills, and 1 to 2 brokerage and retirement accounts. The system should be simple, and here's your blueprint of how your everyday money should flow. You deposit all of your income into one single checking account. If your employer offers a retirement plan, a portion of your money will be deposited there before it gets to you. From your checking account, you're going to set up automatic transfers to pay your bills, make debt payments, your monthly credit card payment. This is the single credit card that you use regularly for essentials you can't auto pay, like groceries or gas, and fund spending money like shopping, going out, anything you spend your money on throughout the month. Then you'll have automated transfers to your savings account and to your investment accounts. Across all of your investments, you should have 1 or 2 tax-advantaged accounts and 1 individual brokerage account, and you'll thank yourself when the time comes to do the taxes. Which brings me to the wealth building principle number 10. learn how to pay less taxes legally. Knowing tax rules and hacks is part of financial literacy. And here's the playbook. Number 1, know the accounts and the rules. This includes the accounts you qualify for, general contribution limits, and how they change based on your income. Number 2, know the legal workarounds intended by the tax code. This means knowing how to do a backdoor Roth IRA if you make too much money, how to do a 529 to a Roth conversion and when it makes sense, and how to convert your health savings account to your retirement if you're not using the funds. Number 3, learn and understand the asset exchange principle. This allows you to avoid taxes when you buy and sell same types of assets. And number 4, understand gifting rules so that you know how to move wealth efficiently within your family by gifting appreciated assets to family in lower brackets or paying tuition or medical bills directly to institutions to avoid tax gifts. Taxes are very nuanced, and if your tax situation is more than just the standard scenario of salary, investments, and common credits, consulting a tax accountant would be money well spent. The consultation money you'll pay for the advice will come back to you in tax savings after you understand the rules. And that's it. That's the playbook. The 10 wealth building principles with everything you need to know about how to gain control of your finances, what grows wealth, where to spend your effort, and how to think critically when making financial decisions. If you want to DIY your own financial advice, don't forget to download the guide. The link is in the description below. Thank you so much for watching this video. If you enjoyed it, please like, subscribe, and leave a comment or question for the next video. This will help me make more content that you're interested in. Thanks again for watching. I'll see you next week.